Okay, thanks everyone for coming. Wealth in America. New estimates and implications for taxing the rich is joint with Matt Smith-Fishery, Owen Zadar at Princeton. We circulated an earlier version of this paper last summer, collected a bunch of feedback in the fall, and finished a significant rewrite just a few months ago. And so I'm looking forward to getting feedback and hearing folks' impressions on the changes we made, which basically just to refine what we had, the main messages of the paper that was sort of circulating back in the fall. Okay, just to motivate things, the question we're interested in is how concentrated is wealth in the United States? Unlike with income, there's no systematic database recording individuals' wealth in the US, so we have to resort to various methods to estimate the wealth distribution. Here I've put up the leading estimates from the three most prominent methods for estimating top wealth. I've plotted the top 0.1% share of total household wealth going back to the beginning of the 20th century according to each method. Just to give folks a frame of reference, in our data, the top 0.1% threshold in 2016 is $14 million per person or $28 million for a household. Okay, so in blue diamonds, we have what's called the estate tax multiplier method. This was most recently used by Kopchak and Saez. What this approach does is it takes wealth estimates or wealth measures from estate tax returns and then estimates wealth of the living using age-based mortality rates to blow up basically wealth that's observed on estate tax returns to estimate wealth of the living. What this series shows is high wealth concentration in the early part of the 20th century that came down mid-century and then didn't really recover since the 1980s. You might be concerned about sort of estate tax avoidance technology and other issues with age mortality rates and how they've changed over time. So maybe questions about that series. Then another approach, the Survey of Consumer Finances. This is a high quality stratified survey designed to especially sample from folks at the top of the wealth distribution. That's the green triangle that shows a slightly higher wealth distribution or concentration and also a modest trend. For privacy reasons, the SCF doesn't include the Forbes 400. So if you take the Forbes 400 measures off the shelf, add them to the SCF, then that's what the hollow triangles are showing. So basically a level shift. You might have issues with response bias or that these are self-reported wealth estimates in the SCF. So a third approach, most recently pursued by Saez and Zuckman in their 2016 QGE paper, takes capital income data from income tax returns. So this is observed capital income flows, uses a capitalization model to blow up those income flows to estimate the wealth distribution. And that's what the red shows, two approaches. One is to do it at the tax unit level. That's what Saez and Zuckman did. Another is to do it at the tax unit level, but then split up joint filers so that you have an individual level measure. And that's what Piketty, Saez, and Zuckman do in their income inequality distributional national accounts paper. What those series show is similarly high levels of wealth concentration to the estate tax data in the early part of the 20th century. It came down mid-century, but then recovered quite dramatically in the last 20 or 30 years. So comparing across these three methods, they're all sort of after the same estimand. We see quite different stories about the evolution of wealth inequality. Another difference across these series the graph doesn't show is there's also differences in the underlying composition of top wealth. And so the story of who the wealthy are and where did this wealth come from is also quite different across these series. So what are we going to do in this paper? We're going to jump into this debate, attack the question, what is the level and composition of top wealth in the US, using an approach that essentially builds on Saez and Zuckman's capitalization approach. So we're going to be taking income flows and trying to estimate wealth from those flows, and from also adding new data that allows us to improve the models in several dimensions. So the most important thing I want you to have in mind is we're going to be accounting for return heterogeneity and mismeasurement with new data. So what is return heterogeneity? Why does that matter? If returns are correlated with a person's wealth rank, and you neglect that correlation when estimating wealth from the observed income flows, that's going to induce a bias in wealth estimates that's we're going to show is material and tends to bias upwards wealth concentration estimates under an equal returns approach. Second, there are reasons to believe that, say, the financial accounts data that are used to estimate private business wealth, because of the limitations in what data is available, might have low private business valuations. So we're going to develop independent estimates of private business wealth using some standard tools in the finance toolkit to account for potential bias. Really, it's going to matter more for the composition of top wealth and the level, but it's another innovation in our paper. When we do this, we're going to be using new data which links people to the sources of their capital income, specifically to the firms they own. In the case of pass-through firms, where we have an explicit link between people, their point in the income distribution, and the firms that they derive a lot of their wealth from, we're going to use that, the characteristics of those firms, to improve wealth estimates. The paper has two parts. The first part is a kind of methodological exercise that goes asset class by asset class, documenting why return heterogeneity and these other valuation and measurement issues are important, and trying to measure the bias for all these asset classes. So the 5 asset classes we're going to go through: fixed income, public equity, private equity, specifically pass-through business, housing, and pensions. And then we're going to provide new wealth estimates, asset class by asset class, add those up, and explore implications for a range of questions, thinking about the distribution of wealth inequality, how it's evolved across states. We're going to look at implications for income and wealth taxation as well. And this will be my last slide before I take some questions. Key findings of 3 groups. First, in terms of concentration, relative to an equal returns approach, we're going to find that wealth is concentration is lower and has risen less. So in particular, the top 0.1% wealth share in our preferred series is around 14% versus 20% under an equal returns approach that neglects return heterogeneity. Because we agree more about the level of wealth concentration in the 1980s, the rise since 1980 in top wealth shares falls considerably under our approach by nearly half relative to the equal returns approach. The purpose of our paper, our worldview, our reading of the data does not support the idea that wealth concentration is low. We are not trying to make that claim. The top 1% share is nearly as high in our series as the bottom 90%. It's certainly something interesting to study and think about from the perspective of policymakers. We're just trying to get the facts straight, understand what's going on in the data to improve science and our collective knowledge. Second, in terms of composition, we're going to document a large role for private business, larger than maybe previously understood. In particular, the top 0.1% wealth portfolio is going to be 36% coming from private business in our preferred series. In terms of implications, we're going to find that our estimates are going to mechanically reduce how much you would expect to get from recent proposals for a wealth tax, because of the dependence of such a tax on concentration at the very top of the wealth distribution. Also going to have implications for the top capital share in broadly defined national income. So we're going to find the top 1% capital share in distributional national income falls 15 percentage points in 2016, so in the cross-section, which is quite a large change in sort of understanding the composition of top incomes and thinking also through how you might tax top incomes. For the growth of top 1% income shares since 1980, we're going to find capital income accounts for a relatively small share, so 2.4 out of 8.1 percentage points, although a bit more since 2000. This is also going to affect the level of top income shares in broad distribution of national income and measures of top tax progressivity. So thinking about the average tax rate along the income distribution, the average tax rate at the very top of the distribution. In short, we're going to find that accounting for heterogeneity and mismeasurement matters a lot for things that we care about, such as understanding drivers of wealth and income inequality, and also for policy, thinking through the design and enforcement of the capital income tax, the estate tax, and the wealth tax. Okay, that's the introduction. Happy to take some questions.
All right, questions. How should we think about human capital? Is future income from labor considered wealth today?
Yeah, Kenneth, good to see you virtually. The question of human capital is definitely near and dear to our hearts. We are not going to be, including an estimate of human capital wealth here. But if you wanted to think about kind of the value of the dynamic program for a person, what is the net present value of their future consumption or something like that, you would think human capital is quite important. We're going to be focused on measuring a narrower thing, which is going to be kind of financial wealth or wealth that's, say, bequeathable or taxable under a wealth tax. Now, of course, pension wealth or deferred labor compensation is kind of an interesting, tricky point there. But yeah, I think I'll get to what we are going to be including or excluding. But when you think about wealth inequality in terms of consumption inequality, just focusing on financial wealth is definitely going to be missing stuff. So that's what I have to say about that.
I don't see any questions in the chat, but I have a question for myself. So can you comment on the, we have different ways to measure, think about this inequality in the society. One is wealth inequality, another one is consumption inequality, right? So what you are basically looking at is the wealth inequality here. And you don't find there's as much change as some previous studies find. How would your results, you think, compare to the studies which look for the income or consumption, inequality over time?
So my general understanding is that while it's hard to measure consumption inequality, especially once you start zooming into the right tail, measuring consumption is quite difficult. It becomes a lot more durable goods, charitable contributions, membership in clubs, like weird stuff that I think you can measure, but it's like a little difficult to measure. But the consensus from the consumption inequality literature, to the extent it's there, is that consumption inequality has gone up less than income and wealth inequality. So to the extent that we're showing less of a rise in wealth inequality than what you maybe previously would have thought, that would, I guess, line up better with trends in consumption inequality, but I don't know if I have more to say beyond that. But yeah, I think, again, sort of wealth is a summary statistic and useful for answering some questions, and it's an incomplete answer for other questions, like what you said, consumption inequality, and like what Kenneth was asking about, sort of it's an incomplete measure of kind of the stream of future income that people have available to them. But it's useful for thinking through, especially, coming at it as I do from the tax perspective. Okay, different tax policy instruments, say we need to raise a certain amount of revenue, what are the likely revenue consequences of implementing different types of taxes? So this is, a useful measure of that tax base. It's not sufficient for answering those questions either. You need behavioral responses too. But I do think it's kind of useful to think about measuring this kind of thing.
So it seems like for every question you answer, there are 3 new coming. So let me read a few more.
Good. So Min Kim, go ahead.
Yeah, let me just, could you please explain why private business valuation must be necessarily low?
Oh yeah, so specifically, so what Size and Zuckman use, and also what's just in the financial accounts, is coming from, Fed economists estimating the value of private business using sort of aggregates and an imperfect valuation methodology. And the reasons that, first of all, like when you look at that aggregate versus something that looks more like the aggregate of private business in the SCF, there's a huge gap between them. So I think there's just a lot we don't know about the overall value of private business. It's hard to measure because we don't have, a market for it that's clear and liquid. So we're going to provide another set of estimates that's going to be higher than what you would pull out of the financial accounts. But so it's basically incomplete data that the Fed doesn't have access to, the universe of firms and what those things would sell for if they were traded on the market. It's hard to do for private business. In other countries where they implement wealth taxes, to the extent that private business is included in the tax base, they usually use book values because it's just sort of impossible to verify the market values, at least historically. So this is just an issue for administration of estate and wealth tax. So we're just going to try and provide another estimate and talk through some of the issues that come up when trying to estimate private business wealth.
Okay. What about persistence? How stable is 0.01% at the top of the distribution?
Yeah, so this is a really great question, because to the extent wealth is a sort of a stock or state variable, you'd sort of hope that it's relatively persistent, at least in terms of, we'd hope that our estimates imply significant persistence. In these data, and this also goes to most of the data that have been used in the inequality literature, including the surveys, including the stratified income tax data that Piketty, Size, and Zuckman use. You don't have the ability to follow people over time in a consistent way and answer this question. So these are repeated cross sections. Could be quite misleading if there's a lot of churn at the top. When we estimate public equity wealth, we're going to provide some evidence that suggests that if you use realized capital gains to estimate public equity wealth, you're going to be estimating a relatively low persistent variable there, because capital gains are lumpy and mean revert. And so we're going to not use capital gains as much as what has been proposed elsewhere. But I think going forward, we'd like to do more using population level data. We have a little bit in an appendix looking at the persistence of different capital income flows. Fixed income and dividend income flows are quite persistent in terms of their ranks. Capital gains less so. Wage income somewhat between them. But I think it's a great question. We don't have as much to say as I would like to say, but the paper's pretty long already.
There's this feeling that there could be a lot of hidden wealth. Any way you try to address that?
The only way we're trying to address that right now, so this would be specifically offshore wealth, is by using, Zuckman's sort of estimates to get a sense of how big that could be. It's maybe a few percent of national wealth, so it's not going to change our main findings, even if we included it and took those estimates off the shelf. I mean, I think we know that relatively little about that. There's a feeling that there's more hidden wealth and offshore wealth in Europe than there is in the US because of kind of cross-border stuff and, the way tax havens and international outside taxes is handled within the EU. So I think it's relatively unimportant, but we just don't have that much here to say about it. So that's also another avenue for future research.
All right, probably the last question at this point. So there are two separate issues of wealth and control. Ford family wealth is now a fraction of market cap of Ford, but they control the company. How do you think about these issues?
I mean, I guess sort of naively, in that we're going to be essentially valuing the cash flow stake using some model of it that doesn't account for control beyond the cash flow stake. For public companies, you're going to have, just basically dividend flows that you have some model that maps those dividend flows to a value of wealth. It's not going to account for control at all. For private companies, most of the private companies are very closely held. So maybe the wedge between ownership and control is smaller. But I think it's a nice question. But I'll just tell you exactly what we do, and then we can maybe talk again about it again.
All right, thank you. Let's move on then.
Okay, here's the model. Very simple. It's not our model, by the way. But if you wanted to estimate wealth W from what you can observe income Y, here I'm going to take the case of sort of a perpetuity kind of console bond example, which is relatively simple, but you could use, say, Gordon's growth model or something like that. You invert the equation and you can estimate W from Y using 1 over R. We're going to call that the cap factor, capitalization factor, but you need that rate of return R in this example. Under the equal returns approach, we're going to try and proxy for R using the aggregate rate of return, which is the aggregate ratio of Y, which is observed fiscal income, component by component, to W, which is observed wealth, component by component from the financial accounts. So for income, we're going to be using these de-identified treasury tax files. These are stratified samples. They include everybody at the top of the income distribution And then below that, people with weights. This is what was used in Piketty Size's income inequality paper in 2003 and has been used subsequently by Size and Zuckman and Piketty Size and Zuckman. The wealth number is going to come from the financial accounts, which Size and Zuckman then sort of tweak a little bit to harmonize with the UN system of national accounts. Total assets minus liabilities of household at market value, excluding durable goods. We are no longer excluding unfunded defined benefit pensions. We're going to be including that as our estimate of wealth, but excluding nonprofit wealth. This aggregate is going to be different than, say, the aggregate that shows up from the Survey of Consumer Finances. So I talked in the answer to the earlier question about the aggregate for private business, but other components could be different as well. This is also going to exclude a measure of the value of Social Security wealth. So we're going to include unfunded private DB pension wealth, but we're not going to be including public DB pension wealth, such as Social Security wealth. We do have an appendix exhibit that incorporates a recent estimate by Sylvain Catherine, Natasha Sarin, and their co-author, whose name is, I think, Miller, something like that. I apologize for not remembering his name. That estimate is important, so we can talk about it later when we get into the pension section or when we talk through wealth inequality. But if you want to think about future consumption, Social Security is certainly important. If you want to think about wealth tax, maybe less so. But thinking about the evolution of wealth inequality when the background context of social insurance moving around is probably important to keep it in mind. The example I'll walk through is going to be taxable fixed income assets, which is sort of the simplest example and also quantitatively the most important adjustment in terms of the return heterogeneity affecting the level of wealth inequality. Okay, so the flow you want to have in mind is taxable interest income. So this would be the interest income that shows up on a person's tax returns. And W is going to be non-tax exempt interest-bearing assets. Okay. This graph just shows aggregates for the different categories, scaled by national income. This is not all of national wealth, just sort of the 5 most important categories. C corporation wealth is including public equity and also private equity in C corporation form, your traditional corporations. Fixed income assets, so the blue, you can see started out at about 80% of national income, rose a bit in the 80s and 90s, thanks to Reagan and Cheney and stuff, declined a bit into 2000, then rose a bit again, and ended up at about 90–95% of national income. Okay, you can see public equities, that's the red squares, sort of fell in the mid-1970s. You can see the dot-com boom and bust in around 2000. Its level is around a little below 80%. This is going to be C corporation wealth directly held by households. This is not going to include C corporation wealth held by pensions, which is reflected in that gray series that's gone from 40% of national income all the way up to 160% in recent years. And then you can see the housing boom and bust there, and also pass-through wealth about the same size as C corporation wealth. And then aggregate flows. So this is going to be aggregate flows from the tax data. The blue series is the fixed income series to focus on. We can see the rise during the Volcker period of taxable interest income that then fell in the 1990s. And in 2016, the last year of our data, it's actually at its lowest point relative to national income the entire time series. Okay, so to the extent that you want to take the ratio of this graph to the previous graph, that would give you that one estimate of the aggregate rate of return that would be used in the equal returns approach. Other series some points to mention: pension distributions have gone up a lot, especially as the population has aged, and also, say, defined contribution pension plans have taken over in importance since the late 1970s. Pass-through income, which is what we studied in our Capitalists in the 21st Century paper, you can see fell a bit and rose as sort of the highest capital income flow on the graph Capital gains don't see much of a trend, but you can see large spikes around the housing and dot-com bubbles, and also around the '86 tax reform, which changed the tax rate on realized capital gains. Dividends are relatively stable, around 2% of national income. Property tax deductions around 1%, which are going to be the capital flow used to estimate housing wealth. Okay, so maybe there might be some questions about any of those aggregate flows. I'm going to jump into the heterogeneity model.
Let's go into the model now, and then I guess the questions will start coming soon.
Cool, great. Okay, so let's generalize the model a little bit. We're going to consider two groups, the top and the bottom. We'll focus again on fixed income wealth. For top fixed income, you have the relationship between wealth and the rate of return on that fixed income. It's going to be group specific. You have the same for the bottom. And then you're going to have aggregate wealth is going to be equal to the sum of top and bottom. So blue are going to be things that we observe, red are going to be things we don't. 3 equations and 4 unknowns. So to make progress in actually estimating and solving this equation, we need some assumptions or some new data. So here I'm going to compare the two approaches that we compare in the paper. One is the equal returns approach on the left. The assumption here is going to be aggregate yields for everybody. So everybody gets the same rate of return. If we were all holding the exact same asset, this would be a totally reasonable assumption. Okay, and so I'm going to break the groups actually into 3 groups, because that's going to correspond to what we now do in the paper. R bar is just aggregate fixed income flows divided by aggregate wealth. So you can invert that or take the reciprocal. You have a cap factor, multiply that by the observed flow for different groups. How do I define these groups? Because we don't observe wealth. We're going to use the observed distribution of that particular flow. That's also worth noting that that's exactly what you would do if you were using equal returns. You'd be ranking people by their flows, because a linear transformation preserves ranks. On the right, for heterogeneous returns, you're going to see that the top get a higher yield. Okay, now we'll show data that supports that assumption. So we're going to use the AAA corporate bond yield if your fixed income flows greater than the 99.9th percentile of fixed income flows. We'll use the 10-year treasury yield if you're in the top 1% to between the top 1% and the top 0.1%. And then you actually have the residual amount of income and a residual amount of wealth, which you can use to compute the rate of return for everybody else. This also gives you a bit of an over-identifying assumption that you can use to test the model. Okay, so on the bottom you can see here we're basically using external data to solve the system, get different rates for different groups, capitalize their flows accordingly. It's easier to think through an example with numbers. So here's an example using 2016 data. On the left, there's $102 billion of fixed income flows that's observed on tax returns. There's $12.6 trillion of wealth to allocate. This is going to correspond to an aggregate rate of return of 81 basis points, or equivalently a cap factor of 124. So that means that for every dollar of fixed income flows we observe, we're going to assume the person has $124 of fixed income wealth. Okay, and that's going to be true for the top 0.1, who has $51 billion of fixed income flows. They're going to have $6.3 trillion of wealth, or about half of the total. The next group's going to have 3.6. The next, and the bottom 99 is going to have 2.7. On the right, here I plug in the rates for those different capital market rates. 3.66% for the AAA yield, 1.84% for the US Treasury 10-year, and then 23 basis points is going to be the residual implied. The cap factor at the very top is going to be 24 instead of 124. So that same $51 billion in our model is going to correspond to $1.2 trillion of wealth, $5 trillion difference, which is several percentage points of total wealth. So it's quantitatively quite important. The next group is going to have 1.6 trillion. The remainder is going to have 9.8 trillion. If you took the flow they received to that 23 basis points, you could think of that maybe reflecting the average yield on deposits and other sort of low interest fixed income accounts. And I'll show some more evidence on why that's the right type of asset to be thinking about. Okay, and then let me just do one more thing and I'll take some questions. So this was the point I made about under equal returns, if you just rearrange the capitalization factor, you're basically just taking a particular group or person's income share relative to total income in that category and allocating total wealth that way. Note that this is going to imply that the wealth rank within asset class equals the observed income rank. That's useful because we can then just plot the distribution of these different income flows to see how under equal returns the evolution of predicted wealth looks. So what we have here is the top 10%, top 1%, top 0.1% of just taxable interest income, where we've ranked by taxable interest income. We can see, say, the top 1% had about only 30% of taxable interest flows in the 1960s. That's risen to 80%. So 80% of the taxable interest income that we see in 2016 goes to the top 1% of flows. The top 0.1% has now only almost half. This sharp increase in concentration of fixed income flows is going to, under equal returns, correspond to a sharp increase in the concentration of fixed income wealth. It's going to matter for total wealth as well. Okay, so let me take some questions on that.
All right, so how can you apply the equal return approach to primary residences which do not produce any income?
Yeah, so what you do is proxy the capital flow that we do observe is property tax, which is proportional to the value of the residence. And so you're going to basically use the property tax deduction to estimate housing wealth. That's going to be an imperfect model, but that's basically doing the best we can just using the flow data. If we had very fine geographic data, maybe we could do a bit better. What we're going to do is allow heterogeneous mappings of property tax deductions to housing wealth across states, because states have very different property tax rates, as those of us who live in Illinois are keenly aware.
Are you able to capture 401 contributions which do not show up since tax only at withdrawal?
So the pension model is going to combine wage income, age, and pension distributions. So for people who are not yet withdrawing from their pensions, we're going to have an estimate based on their age and wage income. And we're going to use SCF data where you observe pension wealth and also these flows and age to try and basically calibrate or estimate that model. And then we're going to take that model into the tax data to estimate pension wealth, including when we don't observe distributions.
For measurement and implications of tax and wealth, how do you think about old money accumulation by incumbents versus new money entrants? You might expect the sources of wealth or rates of return to vary.
Yeah, so we can only do stuff. We don't yet have the intergenerational element to this, but I think it's quite fascinating to think through. Good to see you, Prab. And I would definitely like to dig into this more in the future, thinking through also maybe using the estate tax returns, thinking about intergenerational transfer of, say, private business, this kind of stuff. But right now, we're just going to be, say, observing flows of income. We're going to try and use those flows plus other data that we have to estimate a model, an empirical model of wealth from those flows.
You show that high income people have lower wealth than prior estimates because their yield is higher. Should we think of the higher yield earned by high income household as risk or alpha? Does the gross model assume it's risk or alpha?
I don't think the model is going to take a stand on whether it's risk or alpha. My reading of the data is that significant R squared goes to risk, and then remains R squared for alpha as well. And that because we're just trying to map income to flows and basically do it with a little bit more heterogeneity. We don't have to take a strong stand on that, but I do think for welfare, it's pretty important to differentiate that. So I'd encourage folks who are interested in this topic to dig into it a little bit more. But I'll show you, probably risk is an important piece of it because of how broad the bucket is that generates taxable interest income.
Can you capture uncertainty or imprecision in the estimates? Because yes, results seem to be quite a lot driven by what exact rates of return you apply for different parts of wealth distribution.
Yeah, so we haven't done a lot of kind of bootstrapping. You can use sampling weights in the SCF, and we thought about doing that category by category. When I show you kind of how our adjustment changes the estimate, you're going to see that it's not sort of classical measurement error. It's really about dealing with issues when empirical models are close to zero for rates of return. And when those things are close to zero, you could imagine pretty wide standard errors if we're trying to capitalize very low rate of return assets. I think getting some standard errors on these things is very consistent with our view that, we're trying to communicate there's still some uncertainty and you shouldn't take our estimates necessarily off the shelf. But we do think we're making an improvement, but also I think highlighting that uncertainty is important.
So what criteria are you using to choose the rate of return for top, 0.1% or top 10%?
Yeah, that's coming.
Okay. All right, let's get to that.
Cool. All right, so that's coming right now. Okay, so fixed income. The box, the instructions from the IRS, the box for fixed income says that this box should include interest on bank deposits, accumulated dividends paid by a life insurance company, indebtedness, a lot of different categories. The main point is that taxable interest income is a broad bucket that comprises many different categories of assets delivering fixed income to owners. So let's try and measure that heterogeneity. On the left, we have the SCF's fixed income portfolio composition, where we've sorted people by net worth in the SCF, okay? The 0 to 90 group, 80% of their fixed income portfolio is liquid assets and deposits, including money market funds. The top 0.1%, you can see more than 60% is fixed income mutual funds, not including money market. Another 20% are bonds, and just less than 20% are liquid assets. So you can see considerable heterogeneity in the portfolio composition, which kind of aligns with our finance professor intuition. The more wealth you have, the more, say, liquid assets you have, you're probably not going to leave that all in the deposits, the checking account. You're going to allocate towards more illiquid but higher return assets. And this is also partly answering my question, Kenneth's question about, I think risk is important, just basic differences in maturity, liquidity, some of the characteristics of fixed income assets. I'm not, say, comparing two types of bonds. I'm literally comparing deposits with, levered CLO mutual funds or that kind of thing. Okay, and if I just neglect that people hold different stakes in those different types of assets, then I'm going to neglect all the heterogeneity and mapping income flows, $1 of fixed income flows to an estimate of how much wealth they have. On the right, and this is where we choose the rates that we have, we're going to use the SCF and also estate tax returns linked to the income tax return for those same people in the year or two before when they pass away. Okay, we're going to use that because then we have both the flows and the stocks. We're going to estimate for each group in the fixed income flow distribution. We're going to estimate sort of what is the average rate of return on taxable fixed income assets. And we see, first of all, this is not a flat line on the right, but it's clearly increasing in fixed income flows. At the very top, the AAA yield is a reasonably good proxy on average. It's also holds in the sort of low interest rate recent years. Then the US Treasury 10 yield is sort of the intermediate asset that we chose, but you could choose a different one, or you could choose these rates exactly. The only issue is you don't necessarily have them for all the years that we want to estimate top wealth. And then you can see the 90 to 99, the deposit yield averaged across all these years is reasonably close proxy. We're actually going to use the deposit yield in our estimate. We're just going to use that residual approach so that everything adds up to the aggregate. But you can sort of see where we find justification for the heterogeneous returns we choose. There's been some back and forth on Twitter, and also you can see our online appendix J about what interest rate we should use to capitalize interest income at the very top. And, this is why we choose the rate we do, sort of disciplined by the data. But frankly, choosing the 10-year treasury yield is going to considerably bring down the wealth estimate relative to the equal returns estimate. So we're not necessarily opposed to that. It's just sort of about letting the data tell us what to do in estimating wealth. On the left, we have the average interest rates. You can see the rise and fall across different potential measures. The implied SCF and estate rates look pretty close to the AAA rate. On the right, and this is where the divide by zero point becomes really salient, we have the capitalization factors implied by taking 1 over those different interest rates. You can see in recent years, the equal returns approach kind of really takes off, and that's because that interest rate is getting close to 0. So there's a lot less disagreement between, say, our approach and the equal returns approach in periods when the level of interest rates is relatively high. So in the more inflationary periods, you know, this divide by zero bias is less problematic. Why is it important to show this difference? This shows that it's not just a level shift, but also a change in the time series, because as we move to the zero lower bound, the bias from heterogeneity is going to be amplified, okay? Okay, so I only have 30 minutes left, so I'm gonna, you know, basically give the high level summary of the other asset classes and what we do so that we can get on to results. For public equity, we don't have just one flow that we can use. We can use both dividends and observed realized capital gains. You might want to use realized capital gains to help estimate wealth for people who don't own dividend paying stocks. The problem, of course, is that capital gains isn't just from C corporation stock sales. We try and measure that. There's a lot of other stuff there. So only 20 to 30% of realized gains in any given year is due clearly to C corporation stock sales. A lot of it is carried interest compensation for private equity and venture capital and hedge fund managers. This is not an apples to apples comparison to sort of realized gains that we might use to estimate wealth for people who aren't in those industries for various reasons we can talk about. Third, we talked about persistence. For that reason, capital gains is not a great predictor for wealth. We're actually going to use the SCF to try and estimate the relative weight on dividends versus realized gains when estimating C corporation wealth. So here what we do is we take actual C corporation wealth in the SCF. We have the flows for dividends, the flows for realized gains. We're going to take a weighted average where alpha is the weight between those two flows and see how capitalized that capitalized flow, the weighted average flow, predicts what the error is relative to actual C corporation wealth. What we see is that the empirical model wants us to put a lot more weight on dividends than on realized gains for some of the reasons I highlighted. So we end up putting a 0.9 weight on alpha, or 0.9 weight on dividends and a 0.1 weight on realized gains. So realized gains provide some additional information value, but not a lot. Okay, so for pass-through equity private businesses, I mentioned that private businesses are the largest source of disagreement between the financial accounts and the SCF, and also reasons why the aggregates might be understated due to incomplete data. So what are we going to do? We're going to do kind of what I teach in my private equity entrepreneurial finance class. You're going to use sort of market-based models, multiples-based models that are kind of like capitalization. And then we're going to use multiple different models to try and account for issues that have to deal with avoidance or accounting that vary across industries, and then average those models. We're going to have an illiquidity adjustment measured from SDC transaction data. And then we're also going to adjust for the fact that pass-through businesses include owner-managers that pay themselves a lot of profits that might look like capital income, but it's actually better thought of as labor income in disguise, such that if they went to sell the firm, it would be worth a lot less than, let's say, the income statement that says there's a lot of profits in this business would imply, okay? So our model is going to be taking the average of basically a sales-based multiple, an asset-based multiple, and cash flow kind of EBITDA style multiple. We're going to have the ability to do this for every pass-through business and then link them back to their owners using the information returns available for pass-through businesses, and then adjust for ownership shares based on that owner's share of distributions, okay? And the reason why it's useful to use sales, assets, and EBITDA, because they're, you know, firms that have sort of losses, and so sales can be useful for estimating the value there. There are firms that have a lot of interest in depreciation deduction, so they have relatively low profits, so you might want to use EBITDA instead of profits. There are firms like real estate, but there's a lot of assets, but relatively low cash flows. And so that's where the assets multiple can be helpful. Where do we get our market multiples? We're going to be measuring, taking from CompuStat at the 4-digit industry level for each year, kind of the value, the aggregate value divided by sort of the aggregate flow for each industry. For industries that aren't well represented in CompuStat, we're going to use the market aggregate. Okay, and we're going to just do this firm by firm, take an average, allocate it to a person, and then apply a 10% liquidity adjustment, which comes from what the SDC data says, the sort of discount for private firms is relative to public firms in M&A in recent years, but pooled over sort of the last 20 years, it looks pretty stable. So that's complicated. Let me go through a numerical example so that some folks get on the same page as me. Auto dealers, so that's NAICS 4411. We're going to have aggregate sales, assets, and EBITDA for all S Corporation auto dealers. This is just a fun example. We have a market multiple of sales of 0.3 times $580 billion of total sales. This is, I think, in 2016. We're going to have an assets multiple of 0.56 times $168 billion of assets, and an EBITDA multiple 6.36 times $6 billion of EBITDA. So adding it all up, taking an average, multiplying by the illiquidity discount, we're going to have about $3 million per auto dealership, which actually lines up pretty well with what, say, if you Google for how do I sell my auto dealership, how do I value it, what practitioners suggest is the right way for thinking through this. We're going to do this across a whole bunch of industries and firms and plot aggregate returns across industries, just to give you a sense of the heterogeneity that our approach allows us to model. So the aggregate return in red would be if we assume basically no heterogeneity and didn't do any industry-specific thing and just sort of took aggregate profits divided by the estimated wealth. Then these blue lines are giving different rates of return for different types of industries. We can see very high implied rates of return for things like legal services, physicians, dentists. So in the service sector where there's relatively low assets outside of the human capital, we're going to have relatively low wealth estimates, which are going to correspond to relatively high rates of return. The flip side is that real estate, hotels, restaurants, relatively capital intensive private firms are going to get relatively more wealth allocated in our estimation measure than what you would get in an aggregate return. This is going to tend to modestly increase wealth concentration, but it's also going to just change the distribution relative to sort of an equal return approach. Sorry, I might stop for a second in case folks have questions on that, just because it's a little complicated. And here's also the aggregate. So comparing the U.S. financial accounts in blue to what the SCF has in the years where the SCF is there, you can see quite a big wedge in terms of aggregates relative to national income. So that's sort of the scope of uncertainty, what we do or don't know about what aggregate private business wealth is in the U.S. And then our blue series in dark blue is going to be with all of our adjustments, and then light blue is going to be without the liquidity adjustment and without the, with the circles rather, and the hollow circles is going to be without the human capital adjustment as well.
Eric, I'm not seeing anything in the chat. Maybe I'm looking at the wrong chat, but I'm not seeing any questions. I'm sure they're coming.
No, it's probably because I blew through that, which I apologize for. But if folks come, I'm happy to answer questions as if folks want to digest, because that was a big bite. Sorry about that. Let me just do the other two asset classes, and then we can talk through results and get a little bit back on time. Housing, under equal returns, you don't account for the fact that different states have different property tax regimes. And so Illinois has very high property tax rates. California has relatively low property tax rates. And so we're just going to allow sort of property tax rates to vary across state over time and use that to capitalize property tax deductions that we observe. Why does that matter? Well, because California has a lot of housing wealth. So our adjustment's going to actually go from California having 10% of total housing wealth to 25%. What I plotted here are the is the capitalization factor for property taxes in California in the blue versus the aggregate US housing factor. You can see sort of almost doubled the aggregate US factor. And you can also see the rise and fall during the housing boom. You can also see the sharp jump up after Prop 13 passed, which was a law that capped property tax deduction growth or property tax growth. Pensions. So what do we do? I kind of explained it. Basically, there's a very important life cycle component to pension wealth. People's pension wealth on average peaks around in the mid to late 50s, basically before they've started accumulating their pension wealth. And so we're going to try and adjust for this. We're going to use both wage income and pension income to estimate average pension wealth. We'll have a kind of dueling models between those two. We've disciplined the model using SCF data, including a recent addition to the SCF, which adds unfunded defined benefit pension wealth by Sabelhaus and Henriquez Volz. This does not include Social Security, which in 2016 accounts for about 200% of national income, something like $30 trillion. So that's a big number, and just something to keep in mind. Okay, adding it all up. Min Kim, do you also include foreign assets? I think the way the financial accounts works is U.S. holdings of foreign assets are included, but foreign holdings of U.S. assets are not. But I'm not actually sure. That's something I should dig into a little more closely. But because of worldwide taxation at the individual level, you should be reporting income on both types. So we should be able to see at least some of that, at least the stuff that's legally, reported. So here I've taken the series from the beginning of the presentation and added our preferred estimate. But you can see that it lines up pretty well with the capitalization under equal returns approach in the mid to late 1970s, but doesn't show the really rapid rise in recent years. Our levels and trends look similar to the SCF, maybe a bit below the SCF plus Forbes series. In recent years, we try and provide some reconciliation of that in the paper, and there are a few potential explanations, which I could talk about later on if folks are interested. Okay. This graph shows under equal returns the distribution of wealth between the 0 to 90, the P90 to 99, and the P99 to 100. You can see sort of this kind of secular rise in the top 1% share of wealth, such that they had more wealth than either group in recent years under equal returns. So now I'm going to use our preferred series instead, and what we see is that while the top 1% share has risen from a low of about 22% up to 30%, they still have less wealth than the P90 to 99 and the P0 to 90 group. Okay, the P90 to 99 group ends up having more wealth than either group. It's important to keep in mind when looking at these long time series, this question of persistence. What the 1965 top 1% is clearly different people than the 2016 top 1%. But
your results end in 2016, right? So
yeah.
Would you like to speculate how your numbers could be affected by the recent tax reform?
By the recent tax reform. Well, so there's like the methodology is going to be affected a bit because different flows are going to be observable. Some flows are not going to be observable anymore, like the property tax deductions for a lot of people who either have their deductions capped, so we don't see that, or switch to the standard deduction, so we don't see that. But the recent tax reform, probably played a role in rising equity values because it reduced the burden on dividends and the corporate tax, and so that would tend to increase wealth inequality. Pass-through stuff a little bit of an open question because they gave a business income deduction which would have tended to encourage more transition into pass-through business, maybe increase the value of those businesses a bit. At the same time, a lot of businesses that are in specified service industries were prevented at the lower rate. So it's still a bit of an open question how kind of compliance and behavioral responses to the recent tax reform shook out.
Okay.
But
All right, here's the question. If you have a few minutes, probably we can add this question now.
oh yeah, so let me, Naveen, I'll take your question when I get to the wealth tax in a few slides. So this table just shows kind of the thresholds, average wealth under specification and under equal returns and the wealth shares. Let's say for the top 1%, we see average wealth go from say 10 down to 9.5, so maybe a 10 to 15% decrease. 5 million in average for the top 0.1%, so maybe a 25% decrease, and then an average 100 million for the top 0.01%, so like a 30% increase. So our adjustments are going to have kind of a telescoping effect that basically is going to be really important for the wealth tax estimates, because the wealth tax is so progressive, depends a lot. Okay, so a little bit more kind of something different. We are able to provide wealth estimates at the geographic level. So here what we do is compute kind of wealth to income ratios across states and look at the change in those over time. From 1980 to 2016, sort of see much more of an increase in wealth to income ratios in coastal states than non-coastal states. Maybe some exceptions here, like Arkansas. So you can guess what's driving that probably. And what's also fun to note here is that this divergence in wealth to income ratios is of similar order of magnitude to what was documented in Piketty-Zuckman's paper across the OECD, so across countries. So there's a lot of interesting inequality and geographic or spatial inequality stuff to dig into in the US. You don't even necessarily have. So that could be sort of interesting to look in the future work. So Min Kim asked a question about liabilities or debt. Yeah, there's been a bit of an increase in debt. And so our estimates, we're going to allocate debt using some data from the SCF, because we basically don't have a lot of flows to work with, except in the case of mortgage interest, which we can capitalize. It's certainly the case that if debt hadn't gone up, that you would have sort of more wealth at the bottom in our estimates than what we have here. It doesn't really matter as much for the top 0.1% level, because sort of debt is relatively unimportant there, although there's still some debt up there for sure. To the extent that the debt is against firms, our estimates are going to incorporate that. But I think sort of this approach is not great for thinking through the distribution of debt below the top, or thinking about that, because you just don't observe a lot of information about people's debt on income tax returns. Okay, let me move to the wealth tax. So here I'm going to show the effect of our estimates on the mechanical tax base from an ultra-millionaire wealth tax. This is a 2% tax on wealth above $50 million, additional 1% tax on wealth above $1 billion. Under equal returns, they're going to be 70,000 50-plus millionaires and 1,200 billionaires. So if you just take their wealth and apply the mechanical tax rates, you're going to have $200 billion of tax revenue, mechanical revenue, before you take into account the various behavioral responses. Under our preferred estimates for 2016, this is going to reduce the number of people above these thresholds. So we're only going to have about 640 billionaires, 50,000 50-plus millionaires, and mechanical revenue is going to fall by about 40%. So, quantitatively quite relevant for thinking through the potential revenue raising that could be done from a new wealth tax. This is still a lot of money, and so it just, could be considered in the toolkit if we decide we need to raise revenue, but it's not. It's probably going to require complementary tax policy to raise, a ton of revenue. So Naveen asked a question about if the deficit's not partially covered through wealth taxes, then we would see higher inflation. Whose wealth is most likely to be affected by that? In our estimates, fixed income wealth is not that important at the very top. And so higher inflation is going to erode the value of those holdings less. They tend to be more equity exposed, which we think of as a better, better hedge against inflation. So I think the distributional impacts of higher inflation, if that were to come, which is also, I think, a bit of an open question in the kind of zero lower bound secular stagnation world we find ourselves in. But I think it's sort of interesting to think through that. It's not totally obvious.
Eric, you've got about 5 or 6
the last few minutes. Yeah, exactly. Okay. So let me, I've got a few more minutes to talk through income inequality, basically. So why would, this is a paper about wealth inequality. What would this have to do about income inequality? Well, it turns out that recent estimates to try and expand beyond what we see in income tax returns to come up with a broader measure of income inequality that distributes everything builds on an implicit or explicit estimated wealth distribution. So if you change the wealth distribution or how much wealth there is at the top, you're actually going to change how much of certain types of capital income you allocate to those people at the top. So what kind of capital income do I have in mind? Retained earnings of C corporations, corporate taxes, interest earned in sort of non-taxable accounts, a lot of pension stuff, owner imputed rents, housing. So there are a bunch of categories of capital income that don't show up on tax returns. You want to come up with a broad measure of income inequality to figure out how to assign that. This is also going to feed into broader measures of tax rate progressivity, which take into account things like the corporate tax, the estate tax, the sales tax, and so forth. So we actually chase our wealth estimates through Piketty, Size, and Zuckman's distributional national accounts to see how much it matters. On the left, you see showing top 1% fixed income under equal returns, our preferred series, and then also the fiscal flows. So our preferred series doesn't show kind of an increase in the importance of fixed income in recent years, unlike what you would see in equal returns. So in equal returns, what you would see is that as interest rates came down a lot, people seem to be loading into fixed income bonds and assets and getting more fixed income flows, sort of counterfactual, I think, from what we see in actual data sets where we observe well. On the right, we can see what effect that has on top capital income, whereas in the equal returns approach, you have a pretty dramatic increase in capital income. We see also an increase, but it's much flatter. In terms of the capital share, labor ends up being much more important under our preferred estimates for top 1% income levels and growth. Interesting, our top 1% shares here on the left go up kind of a similar amount. So it's really more about the composition than it is about kind of how much income inequality has gone up. But it does change the story a bit about what's driving the rise of income inequality. It also changes the story a bit in terms of how would you think about taxing top incomes puts more weight on the importance of the personal income tax, labor income tax, and also taxing pass-through income properly, which is going to be affected by the Tax Cuts and Jobs Act rule changes. A bunch of other implications that we discuss in the paper, I encourage folks to take a look at. Different estimates of savings rate by group, which are relevant for thinking through the relative importance of asset prices and how those have evolved over time, discount rates, how those have evolved over time versus, say, changes in savings flows. Started to talk about life cycle forces, the persistence of wealth and income rank. We have a bit on that. I'd like to do more going forward. And then also this stuff about wealth inequality across states and cities. I think there's really interesting work that could be done thinking about regional divergence, capital flows, how elastic the supply of capital is to changes in local tax policy. It's not in the paper, it's just sort of future avenues. Okay, last 3 or 4 minutes. This is going to summarize our very detailed and hopefully responsive appendix to some questions and criticisms that were raised by Saez and Zuckman on our paper. We think we did a good job in trying to answer these questions diplomatically and comprehensively. Hope you all agree, but you're probably going to have to go to the paper and read the last section of the paper and also a very detailed and fun fact-filled appendix on it. I'm here just comparing the equal returns ranks and preferred ranks fixed income series. On the right, you can see the effect of our adjustment. About 4 percentage points of household wealth coming from just the fixed income adjustment. On the left, we're just showing that this is not really about ranks. So, you know, when you change the wealth estimate, that's also changing who you end up putting in different groups. So there's a re-ranking effect, which is going to countervail and offset a bit the effect of the different model. The ranking effect for this category is relatively small. It's really about changing the model. Similar in terms of the ranking effects for estimating C corporation wealth. What's fun on the right, you can see under different approaches for how much weight you put on capital gains. The spread is about 1.8 percentage points or $1.4 trillion in 2016. You can see the fall and rise of top 0.1% wealth, which follows what's going on with the aggregate stock market. So the COVID shock initially was a really big hit for wealth inequality. And then the recovery since then has probably brought back significant wealth inequality. It was sort of interesting to think about exposure for top wealth. And also the trend in recent years is driven a lot by what's going on in the value of equity, both public and private. Here are the portfolio shares comparing the equal returns approach to our preferred estimate and to what shows up in the SCF. Under equal returns, almost 40% of top 0.1% portfolios are fixed income. Under our approach, it's less than 20%, which aligns quite well with the SCF and estate tax data. We have almost 70% in equity, half of which is private business. Actually, the SCF and estate tax suggest that private business is even more important than our estimates. But so those gives you a sense of kind of where there's still room to work and try and understand the importance of private business, but it seems to be really first order for thinking about top wealth inequality. Okay, last, Saez and Zuckman raised some questions about the Forbes 400, saying that, you know, we basically understate the estimates for the Forbes 400. It's not clear that that was like, you know, really first order moment to be targeting is the self-reported and, you know, journalistically reported wealth of the Forbes 400 has some known issues. But I think that when you dig into the data, it turns out it's a bit less clear, you know, how far off we are or how close others are. When folks at the IRS have linked Forbes wealth to estate tax returns, they found that only about half of Forbes wealth shows up on estate taxes. So that just goes to the fact that it's a bit hard to value and hard to measure. But if you actually take a Pareto extrapolation of Forbes 400 aggregates, and see how it compares to ours versus equal returns, we're going to find that it's kind of in between in terms of the number of billionaires, the total amount of wealth. Equal returns overstates the number of billionaires, the amount of wealth relative to what would be implied by Forbes. If you then take that same Pareto model and go down to the top 0.1% or top 1% share, it turns out that the Forbes 400 implied top shares line up very closely with ours and are well below what the equal returns approach would suggest. So, you know, whether Forbes is a strike for or against our estimates, I think it's a little less clear. It's also unclear how much weight we should put on it, but just wanted to point that out. So these are the shares as I mentioned. So just to wrap up on time, hopefully our findings, wealth concentration is lowered, has risen less, but it's not low. We document a large role for private business. We trace through our implications. We've traced through our estimates on implications for the wealth tax base, the top capital share. And I think the last point to highlight is that these methods do entail uncertainty. It should be made more salient. These estimates are better than nothing, but you know, these are not the indisputable truth. So we should work on standard errors going forward in this literature. But hopefully we're providing some insight and helping raise questions going forward, thinking about, as Prab said, self-made entrepreneurs versus inherited private firms, economic divergence across space, thinking about the relative importance of skilled labor versus rents for human capital intensive income inequality, and there are a bunch of tax policy implications. I'm happy to stick around and answer questions if folks have them, but I should end on time just so that the organizers are happy with me. Thanks so much for sticking around.
Okay, there are a couple of questions that you could address at this point if you want to. I don't know if you can see them.
Yeah. So Kenneth has a question.
But you're welcome to address those now, or you could do that offline. It's up to you.
Sure, I'm happy to stick around and answer questions, and folks can
Okay,
sign
so why
off,
don't we do these?
unless you guys feel like you can do them.
I'll allow you to read those if you'd like.
Sure. Yeah. So Kenneth asked whether it's possible to do some Monte Carlo analysis or sensitivity. I think the thing that we've struggled with a bit is we have these different models. Each of them has an underlying sort of sampling statistical sort of distribution, has different properties, and so we haven't really been able to come up with what we think is a scientifically robust way to generate a distribution for each, then add them up. That's not to say it can't be done. We just haven't done it yet. I think we would love to see more of that in this literature. You could do it in the SCF because you have sampling weights. We even have some sampling weights on these income flows, but it's not really the sampling weights, it's really the model uncertainty that we want to try and generate distributions about. Once you move things away from dividing by zero, there's like less of a role for model uncertainty, but it's really about choosing those rates of return in this low interest rate period, which we are currently in. So yeah, I am very sympathetic to that concern. Min Kim is asking something about predictive regressions, top wealth. I think that's kind of what we're doing for certain categories. So I think we are kind of running predictive regressions, or just sort of using observed flows, estimating kind of the coefficients on those flows. You're saying, could you do it on returns? Well, then we would need panel data, I think, on wealth to sort of look at kind of changes. But in Scandinavian data where you do have that, you might be able to do it. Naveen says, what's your estimate of wealth in the USA? I've heard estimates of 100 trillion to 250 trillion. So we're going to have an estimate that's very close to the financial accounts. It's going to be slightly different because of our pass-through business and pension estimates, but it's on the order of, I want to say it's on the order of 75 to 80 trillion in 2016. It's quite possible that it's like close to 100 trillion in 2020, or in February 2020.
Looks like Min Kim suggests using time series, not data.
Time series data. I see. So I have to think about what we would actually be doing with on the left-hand side, or on the, I'm happy to, if you have maybe a little bit more detail, happy to hear more on what you have in mind.
Okay, well,
we've certainly thought through how to do this.
Why don't we wrap it up there? I'm sure, you know, there were a lot of great questions. I'm sure people could contact you offline if they've got other questions. So we'd just like to thank you, Eric, for the great presentation, very interesting paper. For all of you who participated, thank you. Next week, Ilya Strebulev will be, from Stanford will be presenting. On behalf of Nuri, Andre, MSU, and UIC, again, thank you, Eric, and we will see all of you next week.